All right, guys, what's going on? I know it's been a little bit of time since our last one, but we'll get this straightened out. I should be good to roll. So, what I want to do today is I want to give you a little bit of an update. Um, I'm going to send you an email with your update of what's happening. But right now, I just want you guys to go into chapter 11, and I want you to open up your slides because we're going to start with chapter 11 now. So this way we can keep rolling along to getting closer to our first exam. You are going to have a quiz that's going to be opened up for you, but I'll explain all that in a nice long email to you later on while this video is uploading. Okay, so if you go to your chapter 11 slides, it talks about contributed capital. Now, what we're going to be talking about in contributed capital is our stockholders' equity section of the balance sheet. Okay, chapter 10 was all about bonds payable, which was liabilities, which liabilities is on the right hand side of the balance sheet, and so is the contributed capital section because that's under your stockholders' equity. So that's what we're looking at here. I'm going to go through these slides pretty quickly just because of the fact of some of the stuff that, excuse me, some of the stuff, let me turn my phone so it's do not disturb mode because I love when my wife interrupts my lectures. The first few slides on this is going to be pretty quick and easy. It's basic material stuff that you should be able to look at and just kind of write a couple of quick notes on with it. I will give you a couple of test questions on them, but they're pretty easy test questions, so it's not too crazy and not a lot for you to actually have to worry about. So moving on to slide number 2. Moving to slide number 2. You see 3 boxes, and these boxes just talk about the corporate organization. It's how the hierarchy of a company is set up. So the first box talks about stockholders. Now, as a stockholder, you buy stock and you become an owner of the company. Whether you own 1 stock or 5 stocks or 1,000 stocks or 1,000,000 stocks, owning stock is a form of ownership. Okay, I own 5 shares of Apple. Well, I may not own a lot of Apple compared to the number of shares they have, but I do own 5 shares, so I am partly an owner of Apple. It's just the way that is. That's what the whole situation behind stocks is. You buy stocks to become an owner of a company in hopes of getting a return later, whether it's through what we call capital appreciation or whether it's through payments of dividends. What I want you to know about this slide, though, is stockholders, they invest in shares of a company, and they have 2 jobs. Okay, 2 jobs that a stockholder has is A, they vote for the board of directors, okay, and they invest capital. Those are the 2 jobs that a stockholder has. They have voting rights, and they go ahead and they invest in the business. Now, the nice thing about stocks is how easy you can get in and get out. Meaning I could buy a stock at 9 o'clock in the morning, and at 9:05 I can turn around and sell that stock. So that's the one nice thing about owning stocks is the ease of transfer of ownership. Okay. The next one is what we call our board of directors. It's also going to be known as the BOD. If you hear me say BOD, that simply stands for board of directors. Okay. They determine company corporate policy, they declare dividends, and appoint the corporate officers. Now, I will ask you what are 2 responsibilities of the board of directors, but I want to explain how important it is what the stockholders do. As the stockholders go ahead and elect the board of directors' jobs are important, and they do have repercussions on the stockholders. And the biggest repercussion they have is the one thing there where it says declares dividends. Okay? The board of directors are the ones who declares the dividends, which means you as a stockholder, you buy a stock for either A, dividends, or B, long-term holding for capital appreciations. So if you elect a poor or really crappy board of directors, the chances of you getting a return on your investment through dividends could be slim to none. Okay? The other thing that happens if you elect a poor board, they appoint corporate officers who are the ones who are in charge of running the company. So if they're poorly doing their job, then you're not going to have a good CEO a good CFO, a CIO, the COO, all those individuals that are in charge of running the company. And if you don't have good management, typically the company doesn't do well. So you have two things going against you if you don't have a good board of directors. One, you don't get paid dividends, chances are, or they pay too much and then your company goes bankrupt. Or B, they have appointed poor corporate officers and the business doesn't perform well anyway, in which it causes it to go out of business. So as much as it may seem that the stockholders have a very minute or minimal job, it's very important the things that they do. So it's important that when you get a prospectus or you get your voting in, that you actually go ahead and do it. It takes no time. If we were in class in person, I would be showing you and actually voting some of the shares of stocks that I own, because I want you to realize how easy it is to actually do it. You literally log on to a website, you type in a number, and you go ahead and you vote, and you hit submit, and you're done. It may take all of 2 minutes. I've done it on my phone. I have done it on the computer in Sanford 116. I've done it in class to show you students. That's the one bad thing about remote learning, is that unfortunately some of the real life things that I have in my life that you guys will have in yours once you graduate and get out there and start making six figures like every professor hopes you do, is you miss out on those little things. But key here is that it is an everyday occurrence thing and it does happen. So take it take it seriously, that if you become a stockholder, that you just do your yearly job and vote your board of directors. Again, the board of directors, you see their 3 jobs. Make sure you know 2 of them. I will ask you what 2 of those jobs are that the board of directors has. And then the last boxes are corporate officers. And they're the ones who actually are down on the, so to speak, boots on the ground. They're the one who carry out they are the ones who carry out the day-to-day operations. If you've ever worked in retail before and you've had a district manager come in and say, oh, you got to move that display, it looks really stupid there, and they tell you to move it somewhere else where it looks even stupider and you know it, you listen to the district manager, because that's what the guys upstairs or girls upstairs want done. They may not necessarily always be right, but again, that's micromanagement at its finest. So please understand how these 3 different categories work together. One example I want to point out to you is the gentleman who obviously started Apple. Okay. When he was a corporate officer for Apple, he was fired from his own company by his board of directors. And then after he was fired, he went out and he started several different smaller companies, one of which happened to be a kids movie animation company called Pixar. And soon after he started Pixar, they had some huge success and they ended up selling it off to Disney. And then he came back to work to Apple and had molded it to the company that it is today, God rest his soul, because I can say that probably about half of you guys listening to this lecture right now own some type of Apple product. So the board of directors has some serious control, and to give them that serious control, they're elected by the stockholders. So it is important for you to pay close attention to that. Okay. Now, the next thing I want to do is I want to skip over slide 3 and go to 4. We're going to come back to slide 3 in a few minutes, but I do want to skip over it for this point in time and just move on to slide number 4. We're going to reference slide 3, but for right now, I just want you to skip over to slide 4 for a minute. Now, with contributed capital, we're talking about the stockholders' equity section of the balance sheet. And if you remember back to financial, there should be 2 parts. There should be common stock, or what we call contributed capital, and retained earnings. Okay, those are the 2 components of our stockholders' equity account. Now, slide number 4 talks about stockholders' equity is composed of exactly what I just said: contributed capital and retained earnings. But it also adds in treasury stock. Treasury stock is something that's going to be new to you guys. It is not something that I expect you to know. It is something that you're going to learn about in this chapter and next. So don't get all crazy if you don't understand treasury stock, and we will take care of that. Okay. The definition of treasury stock. Now, you could read it there. It says treasury stock is stock that had originally been sold to stockholders but had been repurchased by the company. Literally, the main thing to remember about treasury stock is a company buys its own stock back. Okay. So, for instance, AT&T buys AT&T stock. That is what we call treasury stock. If AT&T was to buy Verizon stock, that would be called an investment. But the fact that AT&T is buying its own stock, its own AT&T stock back, it's called treasury stock. Now, we're going to discuss journal entries for treasury stock later on in this chapter, but the key here is that it has tactical advantages on why a company does it, okay? And we'll get into them later, but just understand that treasury stock is when a company buys its own stock back. Has everybody got that? Pretty simple. It's nothing crazy. And like I said, just bear with me. Just bear with it. We'll get through it. So now I want to move to slide number 5 for a minute, and I'm going to pause the video for just a second, just to be right back. All right. So now we're going to jump to slide number 5, and you're going to have to jump between slide 5 and slide 3 here for a few minutes. And what I do want to go over is, and I will give you a helpful hint when it comes to handling this situation. Now, parts of stockholders' equity. If you take a look at slide number 3 real quick, go to slide 3. Sorry about that. I want you to take a look at slide 3, and I'm going to go through this with you, and I want you to follow along for me. This is important because you will have to prepare a statement of just the stockholders' equity here. And I will explain to you how it is going to be worded and things like that. But I want to go through this stockholders' equity section first. So as we spoke about, the two components of stockholders' equity is your contributed capital and your retained earnings. Okay. Those are your two main components of your stockholders' equity section. So if we take a look under contributed capital, now this chapter introduces to you preferred stock and treasury stock. You've already had to deal with common stock, or at least you've been given some type of insight about common stock from financial. That's the basic stock that a company does go ahead and issue. The key with preferred stock is it is a stock that is still stock of the company, but there's different characteristics of it. So grab a pen and piece of paper, because I am going to give you some characteristics that I want you to know that are not in some slides that I will test you on. So you're going to have to take a little bit of notes here. So I'll just give you a second to go ahead and get a pad and piece of paper down so you can write some notes down. The biggest difference that I want you guys to know between preferred and common stock. Preferred stock pays a percentage dividend. Okay? That's one thing that happens. Common stock, your dividend is declared by the board of directors. You're not necessarily always going to get a dividend. There are times where common stockholders do not receive a dividend, or a dividend was not declared. The difference with preferred is that they get a percentage dividend, and it's a set amount, where the common stock dividend can change. It could be 10 cents per share one quarter, and it could be $1.50 the next quarter. It all is dependent on the revenues of the business. But preferred stock, another key difference between preferred and stock and common is preferred stock does not have voting rights. Okay? They do not have voting rights. They do not elect the board of directors. Only common stockholders have voting rights. Okay, there's a very big difference there. So preferred stock does not have voting rights, while common stock does have voting rights. The other thing about preferred stock and common stock is If a company is going bankrupt and they're forced to liquidate, meaning sell all of their assets, the reason they're liquidating is to get as much cash as they possibly can. That cash is used during the liquidation process. They pay their liabilities or their creditors off first. And then if there's any money left over after that is done, then that money is paid to the stockholders. Now, here's the key about that. Preferred stockholders are first in line to receive money that's left over during a bankruptcy. Now, most companies are so bankrupt that their assets are not enough to cover them. So it never really, if you have preferred stock or common stock for that matter, typically there's never any money there to be distributed to you. There's never enough. There's barely enough to pay the creditors, let alone any stockholders or investors. But in the perfect world, if there was enough money to go around, preferred stockholders would get their money first, and whatever residual money or leftover money would go to common stockholders. That begs the one point that I want to make sure that you guys all know, and this is a little off topic, but keep in mind when you invest in a company or you invest in stocks, mutual funds, whatever you decide to invest your money in, keep in mind that your entire amount of money that you put in could be lost. The stock market is not a guarantee. So when you invest in a company, you try to invest in companies that are sound, Fortune 500, or what we call blue chip stocks, mainly because of the stability and the fact that they've been around for many, 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 many years. Okay? AT&T, Verizon, Coke, Pepsi, Heinz, Campbell's, companies like that, Nike, those types of companies. Those are companies that have been around for years, and the chances of those companies going belly up is very slim to none compared to, some of your newer tech stocks. I mean, even GoPro could be an example of that. For a while, they were having troubles where they may not necessarily have made it, so just a little bit of off topic. When you do become investors and you start, planning your retirement and stuff, make sure you do your due diligence and you do your homework on those, because money that you invest is money that you have to be able to be willing to lose at worst case scenario. Now, the chances of losing money is always there. I will not tell you that you can't lose money in the stock market, because many people do, but just be smart about the way you go about doing things. All right. So some of the differences, again, were preferred stock, where one has voting rights, the other one does not. Preferred stockholders are paid first. Preferred stockholders are paid a percentage, so it is a set amount. Those are some of the differences between preferred and common. Now, let's talk about how they get listed on the stockholders' equity section. Preferred stock, as you can see, is listed first. It's above common stock. And the descriptions that are after both preferred and common are expected to be written on your statement, on your stockholders' equity statement, when you do this as a homework assignment and as a test question. So as much as it may just seem like, oh, this is very boring, I got to write all this out, trust me, it's the way it's done. Okay. The best part about it is really all you're going to be doing when you do this question is you're going to be recopying something from a paragraph. So it's not like you have to go through and, add 5 things, divide by 2 and multiply by 5. You don't have to do all that. You're literally going to be recopying or retyping or rewriting a sentence that's going to be in the narrative of the paragraph. So it's not as difficult as it may seem. And again, a lot of accounting seems difficult or more difficult than it really is. So just listen to your videos, go through your work, do your assignments, and you should be fine. All right, so preferred stock. Now, the thing I want to point out is how we're going to get the numbers to the right-hand side there. and how those numbers and where they come from. So what I want you to do is make sure you have your calculator handy, and just keep in mind that we are at we are at 20 minutes into this video. So if you have to go back and re-listen to how we get to certain numbers, start at 20 minutes, at the 20-minute marker, okay? All right, so it says here, preferred stock, $50 par value, 2,000 shares authorized, issued, and outstanding. Now, what I want you guys to get used to doing is I want you to understand the difference between authorized, issued, and outstanding. That's going to be one thing that we have to talk about. The other thing that we have to talk about is what we call par value, okay? First, I want to talk about par value. Par value is an arbitrary number, meaning it's made up, okay? There's no rhyme or reason how we get it. It is made up. And that is what they consider like the baseline value of a share of stock. So in other words, what they're saying is that preferred stock has a $50 value. Now, that preferred stock probably doesn't sell for $50, but that's what their book value is. Okay, that's what we're going to call that. That's the book value. If you were to buy a share of preferred stock that has a book value of 50, again, you could buy it for more than 50, you could buy it for less than 50, or you could buy it for 50. So it sounds very similar to what we did in chapter 10 with a premium discount or face value. So it's very similar techniques or qualities. They're very similar in this case. The difference between chapter 10 is we sold bonds payable, which is liability. In chapter 11, we're going to be selling shares of stock. The purpose of selling either one of those items is for the company to receive cash, to receive monetary amounts to do whatever the company needs to do. So keep in mind that both chapter 10 and 11 is all about funding a corporation, how to get money from people, whether it be an investor, meaning stock market, or being from a creditor, which would be your bonds payable, okay? So if you look at preferred stock, it says $50 par value, 2,000 shares authorized, issued, and outstanding. If you take the par value of 50 and multiply by 2,000 shares, that will give you a book value of preferred stock shares of 100,000. So if you look all the way to your right, you'll see that it says 100,000. That's the purpose, and that's how that $100,000 number came up. It's $50, which is the par value, times the number of shares that you have there, 2,000. Now take a look at common stock. This is where things get a little bit more tricky. All right. Common stock. Here it's only got a $5 par value. It has 60,000 shares authorized, but only 40,000 shares have been issued and 36,000 shares outstanding. Now, we're going to talk about authorized, issued, and outstanding in a few minutes. But keep in mind, there are three distinct categories. You have authorized, issued, and outstanding. Now, the way you figure out the value of the common stock is you take the par value. Again, par value is a made-up number by the company. So you're going to take $5 share per share and multiply it by the number of shares issued. Okay? So if you take $5 par value times the 40,000 shares that are issued, not authorized, but issued, will give you your $200,000 number that you see there. The next line says additional paid-in capital. Additional paid-in capital simply is a number that is going to be given to you. That number will be given to you in the narrative of the question. The definition of additional paid-in capital means that we sold those 40,000 issued shares above $5 per share. That's all that means, is that we actually sold the shares for more than the par value. So what you would do is you would write additional paid-in capital, and you would place the number that's given to you. In this case, it's 100,000. And then you'll see that to the right, the very, very far right, we have $300,000. That is the 200 plus the 100 that you see there. So our total value of common stock is $300,000. Our total value of preferred stock is $100,000. The next line below additional paid in capital says total contributed capital. Well, whenever you see the word total, you're going to add. So we got 100 plus 300,000 give us the 400,000. That is all the first part of stockholders' equity. That's the contributed capital section. Moving to the second section under stockholders' equity is our retained earnings. Well, again, that retained earnings number is going to be a number that's going to be given to you. Okay, so that number is going to be given to you. You're going to go ahead and list that. The next line says total contributed capital and retained earnings. Okay, total contributed capital and retained earnings. Well, the word total means add, and you're adding contributed capital, which we already did was 400,000, plus the retained earnings. So 400 plus 120 gives us our $520,000. Okay. Now, this is something that you haven't had to deal with before, and this is new because it is something that we just are introducing in this chapter, which is our treasury stock. Now, I need you to pay attention with the bold-faced headings here. You've got a bold-faced heading that says contributed capital. You've got a bold-faced heading that says retained earnings. And your last bold-faced thing says less treasury stock. Okay? The word less means that you're going to subtract. Okay? The word less means that you are going to subtract. And here it's telling you that you have 4,000 shares of treasury stock. And the value of those 4,000 shares is $40,000. That number will also be given to you. Okay? So, doing what the operation says to do, the word less means to subtract. So your last line says total stockholders' equity is $480,000, which is simply the 520 minus the 40. Gives us our $480,000. Now, just as a ending to this video, because I want to get it uploaded so that it doesn't take 2.5 days to do. You see how many shares of treasury stock it says are out that you have in treasury stock? It says 4,000 shares. Go back up to common stock quickly. What's the difference between the number of shares issued and the number of shares outstanding? If you take 40,000 shares issued minus the 36,000 shares outstanding, that leaves you a difference of 4,000. That 4,000 difference is the number of treasury stocks that you have. Okay? Does everybody see that? If you go back up to common stock, you'll see that you have 40,000 shares issued. And you have 36,000 of those 40,000, 36,000 shares are outstanding, meaning people still own them. The difference, which is that 4,000, if somebody else doesn't own it, then chances are you own it. So in this case, that treasury stock of 4,000 shares is shares of your company that you bought back. Okay? So as you can see there, 40 minus 36 gives us the 4, which is the exact number of treasury shares that we have down below. Okay, so that's going to wrap it up for this first video for chapter 11. The next video is I'm going to start on chapter 11, slide number 5. But I'm going to do that right now. I just want to get this uploading so that we can stop with the long upload times. And I'll be right back to you.